Adobe stock isn't some overhyped AI fad, okay? It's a goddamn cash printing machine. In this video, I will talk about Adobe stock fundamentals and why I slammed the buy button on this stock. Here on my eToro portfolio, you can see I allocated 20% of my hard-earned money in Adobe stock, okay? This isn't some paper trading. This profile is live. You can copy it as well. But anyway, let's get into it. Let's look at the stats. Whenever you start to analyze a company, you need to look at the market cap. Always, at any number you look at, it's got to be in the context of the market cap and also revenue and also margin and so on. But market cap is the first number that you need to know and keep in mind, okay? 164 billion sitting right now, and it's 164. Revenue 22. PE ratio, price to earnings 25. Forward PE 17. It's kind of crazy. I mean, yeah, I'm getting excited just by remembering this stuff. Let's take a look at the graph. For the past 5 years, it's a bit lower than it was 5 years ago, and it had some brutal swings. But here in 2021, 2022, the broader market went down. It went down by 25, 30%, I think. I did not buy it here. I had some other trades, such as Facebook. I was getting involved in Facebook here. I thought it was a better opportunity, but even so, if you bought it at the low of 275, which, I mean, it didn't stay there for long, okay? But you would have done almost double your money if you managed to get it around that price when everyone was panicking. I mean, when it had that big drop of, I don't know how much, 20% or more than 20% in just one day. If you bought it then, you would have almost doubled your money. And usually, as a rule, I'm not completely sold out. It's not a rule that I sell out once I double my money, but along the way, I do take a lot of profits. That's why I even allocate a lot of money into trades that I think are going to be very good. So I cannot let them balloon out of proportion. I need to constantly take profits. That's not a problem for me because I'm always looking for new trades and new opportunities. So there are constantly new trades and being thrown at me. I'm always fully invested, but the way I make money is I buy low and sell high. And it's very important to also sell high. But yeah, I think this is a new low for the company, and we're gonna look at the valuations just in a moment. So here, revenue, top line. Look at that. Not exponential growth, but pretty solid growth. I mean, 10 years ago, it was bringing in almost $5 billion a year. Now it's bringing in 22 billion, 23. Quarterly, look at this. Look at this. Not even a swing, just a small swing here, 2021. A big increase in revenue quarter over quarter, and then a small drop. That's the only revenue decrease quarter over quarter that I can see here. I mean, I don't know how to explain it, but this company is a tank, okay? I want to be invested in this type of company. I want this, okay? This is what I want from my companies, to be bringing in more and more and more cash every single quarter, more cash, not year over year, not trimester over trimester, or quarter over quarter, more and more cash. I mean, it's pretty amazing. Let's just take a look, okay? 2022, the bottom, it was bringing in about 4.4 billion. Now it's at almost 6 billion. So almost 50%. It's soon going to be 50% more money every quarter than it was bringing in when it went down to 275. What's going on here? Shares outstanding. We want to see share buybacks. It was doing share buybacks. We don't want to see any type of share dilution, any excessive stock-based compensation and stupid thing like that. We want to see shareholder focus, okay? We want our companies to return value to us as a shareholder. That's why I invest in companies. I want them to take my money and give me more money than I have initially brought them. So that's why I invest. I'm looking for a return. And this company has been accelerating buybacks lately, which is a good sign. Not just because, I mean, the share count will drop and our shares will get more valuable, but we want to see this as a sign of strength. Anytime a company accelerates buybacks and the management has been doing responsible things and has been doing overall good things with the company, whenever they decide to accelerate buybacks, that's a sign of strength. Okay, they have the money to do it. They're not afraid of anything bad happen, slowing down sales or anything like that. So as you can see, we will take a look at valuation and you will understand that what they've been doing, it's a very wise decision to accelerate buybacks a little bit. As you can see here, 2022, they had a high price. In 2021, they didn't do so much buybacks. We will take a look at dollar amounts as well. But yeah, this year, trailing 12 months is almost 4%. So great news for us if we hold it. Gross margins, 89%, okay? 89%, I mean, what are we talking about here? Yeah, sure, it's a software company, but if we take a look at other big companies, they're not that profitable. They don't have these type of margins, okay? 89 and slightly trending higher. 10 years ago, it was 84. Today it's 89. Up a little bit from last year. I mean, it's crazy. What are we talking about? 36%. Almost all-time high operating margin. What the hell are we talking about here? What's up with the fear surrounding this? It's thank you for the money, I guess. I'll take it. I bought it with both hands. Like I said, I slammed the buy button on this company. 42% free cash flow. 42%. Let's take a look at the software application industry. SAP, Salesforce, Intuit, ServiceNow, Uber, and Adobe. FCF yield. Let's see. Some of these companies are trading at less than 2% FCF yield. ServiceNow and SAP. That's crazy. Less than 2%. You're going to get hurt by buying these right now. Intuit, a lot more reasonable, but still, gross margins much less than our Adobe at 80%, 77, 73. Operating margin, 37 almost. What do these other companies have? 13%. Now, sure, they're still growing and they might improve this in the future, but so as you can see, it's growing. But you're gonna pay a lot higher price for that type of growth, okay? Forward PE is not 17 for this company, it's 59. So I like to make money. I don't want to overpay like crazy just to get a little bit of growth, okay? This company doesn't need any more growth, and yet it's still growing. I could have bought this at the price that it's trading right now. Could have bought this company with no growth. Anyway, you can sit here and compare, but yeah, it's not bad at all. The price you're getting it at, the margins, and let's move to the balance sheet. Cash and cash equivalents, 5 billion right now. Last year they were swimming in 7.6 billion and growing over time. They grow their cash piles. They still have a lot in their coffers. They can allocate this cash to even more buybacks if they believe that there is no good opportunity to right now to do any type of acquisitions, if they believe they don't need to. I believe in the management. Why? Because they've been doing great, amazing things with the company, and I trust them with my money to do great things in the future as well. I trust them to make good decisions. Yes, you have to have a little bit of trust when investing. That's why I don't invest in real estate. I give money to other companies by buying shares and expect returns. I expect them to work for me instead of going and buying properties and trying to fix them up and dealing with people renting out and stuff like that. So anyway, net cash debt, little bit negative. Most of the time it's up. Could very easily next year go back up to 1 billion, 2 billion, whatever. It doesn't matter. The balance sheet is not pristine, but I mean, it's rock solid. I would say it's nothing to worry about. Shareholder equity, it's positive, going up. A little bit of a dip here, but it's probably gonna start climbing back up once they stabilize the net assets and liabilities. But anyway, net income, let's see. Super solid growth, almost exponential. I mean, going from 600 million of net income to more than 10x, almost 7 billion. Yes, okay, it's not exponential, but it's pretty close to looking exponential, okay? Let's look by quarter. I mean, again, the trend is very clear. It's trending higher and looks unstoppable. Stock-based compensation. Now here, we definitely don't want to see exponential growth. Remember, almost $23 billion in top line revenue, and they are paying out 1.9 billion. So about 8% in stock-based comp. Not too bad. Not too worried about this. It's the type of company that will have to pay for talent. It is what it is. That's just the type of industry that this company operates in. They have to have high stock-based compensation. Otherwise, they wouldn't be able to produce the type of results that they've been having. Now let's take a look. This company doesn't pay a dividend, but they do repurchase stock. That's how they return value to shareholders. This is a mature company, and I would expect that they return value to shareholders after 30 years of, or maybe more, of being in business. So let's take a look here. This is very high growth. It's definitely looking exponential. 800 million, trailing 12 months, more than 12 billion. Amazing. Last year, $10 billion. Again, remember the market cap. 164 right now. Last year, they bought back $10 billion. Trailing 12 months, $12 billion. What do we see here? We took a look at the graph. As you saw, the all-time high price was in 2021. And since it's been going down, it plummeted in 2022. They've been doing a lot more buybacks then, okay, from 4.7 to 7 billion. And then when the price got back up in 2023, let me put the price up just so you can understand what they've been doing. The management is not stupid. This is what so here they've been doing their $4 billion of buybacks. Price went down, plummeted. They've been doing a lot more buybacks around here. And then they slowed down the buybacks again when the price got high. This is exactly what I want to see from the management. Not dumping a lot of money when the stock price is overvalued and very high, and dumping more money into buybacks, offering a very solid floor for the price. I mean, it's not going to go lower. With these guys at the top, at the management, they offer a very solid floor for the price. And not only that, not only the tens of billions of dollars that they've been pouring into buybacks, they announced another 25 billion of share buyback ending in 2028. So we have 2.5 years left from that program. So I would say expect 25 billion on top of 65. I mean, that's just going to be great. And they still have a lot of cash left to do acquisitions. And it's not like it's going to cripple them or anything like that. They can go ahead and buy whatever the fears around AI is right now, that they're going to disrupt, the AI is going to disrupt this company. It's not true, okay? Apple went up 2% yesterday because they announced that they're just going to get OpenAI to provide the AI services for them, okay? So it went up 2%. Why is this good news? Because they're not going to burn so many cash to try to themselves try to get AI technology installed. They're not going to burn a lot of cash. They're just going to outsource the technology from someone like OpenAI, okay? So they can buy other companies. They can outsource AI to someone else. There are companies right now that they can offer these type of services like OpenAI. So I don't understand what's the problem. It's not. I don't see AI as a problem ever with this company. So yeah, I think I don't read news or anything like that, but I think the fears are good for me because look what they're doing with the price. PE ratio of 25 for this company. At a low of the last 10 years. Forward PE, look at this, lowest in 10 years. Price to book, 14, not that bad. EV to sales, 7.3, all-time low. No, not all-time, lowest in the last 10 years. EV to EBIT at a low of 10 years. EV to EBITDA, again. These are very cheap. Look at this, return on capital. Look how high it is, 27% almost. And not just the fact that it's very high, but it's trending up. I mean, this company is a tank. Why wouldn't you want to go in a tank? You want to go on a bicycle tour, or do you want to go in a tank, inside the tank, okay? I want to go in a tank. I want to drop my money in a tank. It's going to survive. Not only that it's going to survive, it's going to bring a very high return to me back in just a couple of years. Look at this, 2015 return on capital employed, it was around 10%. Today it's at 44%. This is the perfect type of company. I mean, listen, I wanted to own Adobe stock for a very long time. This is a very high quality. You could buy it and keep it for a very long time, okay? This is the type of company, a very high quality company that you don't have many opportunities to buy it at such a cheap valuation in order for you to keep it for a very long time. Because it's important how much you pay for it. If you paid, this company doesn't pay a dividend, so you're not getting paid to wait. But if you bought it around here in 2021, when everyone was getting hyped with the SaaS companies, if you bought it at 500, 600, you would still be down a lot today. So I buy low and I sell high. I don't buy high and hold for a few years and not make any money, okay? I buy low and I constantly make money. FCF yield, all-time high. 6%, almost double the S&P 500, okay? What are we talking about? The S&P 500 doesn't have these kind of margins, okay? Sure, there are high-quality companies in the S&P 500, but as an average, they don't have 37% operating margin, okay? On average, they have like 15%. Gross margins is like 60. Profit margins is like maybe 8. What are you talking about? Yes, of course, I'm going to buy it with both hands and my legs, okay? Let's look at the ticker terminal. Here you can put the price for Adobe and you can put a valuation type metric on the graph as well. Last 12 months, EV to EBITDA. I mostly use EV to EBITDA, but you can use other stuff as well. Price to sales, whatever. Let's take a look. Last 10 years. So as you can see, black line, which is valuation, it was constantly going down. Every quarter, bam, going down, going down. Price was going up. So the fundamentals of the company was growing at a very high pace, and not even the stock price was keeping up with this high growth. Okay, and then the market was allocating a lot higher multiple for this kind of stock. The price got ahead of the valuation. Let's look at this point in time. 55 times EV to EBITDA in 2021. Okay, when it was at all-time high. Actually, no. It got a bit down when it was all-time high because it was constantly improving. I mean, it cannot stop. As we saw, it's a tank. You cannot stop it. It's going to still grow. Sure, growth has slowed down, but it's still double digits. And look at this, where we are now, 18 times, and the price is where it was 5 years ago. So valuation got down by more than 60%, and the price is has been flatlining for the past 5 years. This is a very good situation to buy in. Anyway, doesn't matter. What I want to show you here, Shiller PE ratio, we're taking a look at after 1980, since the Fed started to cut rates. So I just look at this part of the graph. When it went up, it ballooned in the dot-com bubble at around 44. And we're sitting right now at 37. Last 20 years, as you can see, we are very close to all-time high valuations, as we were in 2021. I do not want to buy very highly valued stocks right now at this type. This is not the moment to have an aggressive stock, okay? I want to be very defensive. I want cheap stocks. I want growth at a reasonable price, but Adobe is growth at an amazing price, okay? Because of surrounding fears. Last 50 years. So as you can see, we are very, this 37x Shiller PE, you do not want to own Nvidia right now, Palantir, and stuff like that. You want to be buying here in 2022, when Nvidia was down a lot. That's a fat pitch. That's when you make money. You buy very high quality companies when they're down in valuation, not when they've gone up 15 times, okay? You missed the boat. Find another boat. So yeah, conclusion. I couldn't care less about the fear surrounding Adobe. I look at the metrics. I'm here to make money. I'm here to own cash cows, okay? Adobe is going to be my cash cow until at least 2028. This is a fortress of a subscription revenue and margin muscle, okay? This is subscription muscle. You're not going to stop this just overnight by, I don't know, some new competitor. they can just buy out competitors, okay? I have no fears regarding this company. This is a fortress. This isn't a hype toy. This is like a relentless profit engine. So that's why I bought it for so much.